out for the difference between accrual and cash accounting when evaluating a business to buy. Now there's two forms of accounting, and the most popular in very small business is what's called cash accounting. So what that is, that's when you actually recognize revenue or expenses when they're paid or received. So for example, let's say you pay $1,200 for 1 year of insurance. Under cash accounting, you're just going to recognize that $1,200 expense whenever you paid it. And on the revenue side, if you do a job for a client today and they have 2 months to pay you back, you're not going to recognize that revenue until you receive the cash flow from the client. Now, this is popular with really small businesses because it's just really simple to do. It's really easy to keep track of, but it's not a very good representation of the actual earning power of the business. That's why accrual accounting is generally used by larger companies. Definitely any public company or anything like that you've looked at uses what's called accrual accounting, which means you realize or record or recognize revenue or expenses when they're incurred. So in our example of the insurance isn't actually just for 1 month, it's for 12. So rather than recognizing the $1,200 expense in 1 month, you'd recognize $100 per month throughout the whole year. Or the same with that job that we do for the client, you would likely recognize the revenue when you actually perform the work rather than when you receive the payment. And this gives a more accurate representation of the go forward earnings power of the business. But what you'll see a lot of companies, they'll do accrual accounting for their profit and loss and for the numbers that they're advertising. But on their tax returns, they'll use a cash basis because often on cash accounting, you can lower your tax rate, especially if you're doing a lot of depreciation or other things that can push down the cash earnings of the business. Where this comes in buying is that banks typically use the tax returns to determine if they're going to lend on a business. So if the profitability of the business is a lot less on a cash basis than it is on an accrual, then the amount that the bank is going to lend you is going to be less than what your buyer may want, because the accrual is showing the true economic value of the business. The cash taxes are showing what the bank will lend. Now, most of the time, the difference between cash and accrual are really small and won't make a big difference. Where it does come into play is you have a fast-growing company with a long payback cycle with its customers. So if the customers have 60 to 90 days to pay for the work that was done, combined with fast growth, you can get a really big difference between your accrual numbers and your cash numbers. And what you could find is that maybe you're trying to buy a business that looks like it's going to make $1 million a year going forward, but the bank will only give you credit for 600,000 of it, and that makes it tough to do the deal.